To build anything that truly lasts, it takes time.
Viewers, let's also welcome on board our charters for the show today. We are being joined by Saumil Mehta as well as Vinay Rajani is also with us on the show. A very good afternoon, gentlemen, and thank you so much for your time. But Vinay, firstly, help us with your take on the benchmark indices, especially that Nifty 50 breaking the number of 25,000. What does it really mean? Do you believe that there's a change in trend overall, or Nifty from these levels can actually make an attempt to surpass those levels?
Yeah, good afternoon and thanks for having me on the show. So definitely weakness is there. Nifty has confirmed the lower top, lower bottom formation also. And if I were to look at the resistance, the 25,255, which happens to be the recent swing high, that is a strong resistance now. And unless that is taken out, we should remain cautious. But today's low is around the 50 days exponential average, which is currently placed at 24,930. So Nifty has given respect to that level and trying to take support there. So any level below 50 days EMA, which is placed at 24,930, any close below that will further ignite the sellers and selling pressure will emerge again. So definitely weakness there, and technically one should remain cautious unless 25,255 is taken out. On the downside, there is a strong base around 24,500 to 25,600 where we saw in the month of June Nifty formed a strong base. So 24,600 to 500 range is a very strong support, and result season is going on. It might happen that some stocks will still perform even if Nifty goes down. So as of now, benchmark is looking weak definitely, and 25,255 should be the stop loss in existing short positions. Until that is surpassed, one should remain cautious.
Remain cautious is the call coming in. Samil, what's your take on the entire metal space? Because barring the entire market, you only have metal and realty that are trying to, just eke out a little bit of a gain amid a largely consolidating market. And especially some names from the metal pack like NMDC, SAIL, Tata Steel. Gains anywhere between 1 and 3% is what we're seeing on these counters. Give us a chart check on NMDC, SAIL and Tata Steel.
Let's start with Tata Steel. Overall, very mixed bag. JSW Steel is not looking good, that good. It's looking a little range bound. But Tata Steel overall has taken support at 20 and 40 daily moving average, has taken the previous swing high, which is a great sign for the stock. I think in the very short term, there could be a bounce till 170 levels, because the reason is there is a upward sloping trend line, and that's a resistance on the upside. So I'm expecting this bounce to continue till 170 and then again take resistance on that upward sloping trend line. For NMDC, again, 200 daily moving average support, high top, high bottom formation, previous swing low, previous swing high has been taken off. So I think a new short-term rally has just started for the stock. I'll be expecting the stock to go up till 70 to 60, and the next level would be 75. So these are the two short-term targets. I'll take a revisit on this stock again once it surpasses 75 levels. So yeah, a little positive on a few of the metal packs, but JSW Steel and Jindal Steel both are looking a little sideways to negative.
A little bit of recovery, if you could call it that, is something that we're seeing on the street, but not much happening. Before we get an understanding of how the IT earnings season has been so far, Dilip, just want to get your sense on another sector that's managing to hold on well, and it has done well over the course of week, given there has been stock-specific news flow, and that's the entire real estate sector. What's your take on this sector? Because post-COVID, we've seen a massive boom. Then for quite some time, this sector has been very quiet, and it seems like some momentum could be returning. What do you pencil? What are you penciling in for the earnings when it comes to real estate? And do you believe that there is still some more upside left here?
Well, I think the best of the real estate run possibly is behind us, and that's what I would think. I think the real estate sector will continue to show a reasonable growth. But the kind of explosive growth that we saw in the last couple of years, especially led by the premium segment, I think now that is waning off, is what my understanding is. And the pain is there in the lower and the middle class real estate units. So I think all in all, what I would say is that real estate will continue to be steady, but whether it warrants a fresh investment, no, I don't think so. I would really wait and watch. And just as one of the pointers, if banking is not going to do all that great, is not doing all that great, IT is under the cloud. So I think a lot of this, the impact of that will be seen in the purchasing habits of some of these people who are the employees out over there. And that will get reflected in real estate, possibly in the urban areas of FMCG. So taking that as a cue, I would say that if I got some of the stocks in real estate, I would hold on. I wouldn't commit fresh in this particular sector.
Right, so that's the take coming in on the real estate pack. But like we have been talking about the IT space, and if we look at the numbers, it's sort of a mixed trend so far for the tech majors for the quarter gone by. Majorly, the companies have disappointed, but yes, of course, there have been some outliers too. So let's go across to my colleague Ashesha, who is here to get us with a roundup and the guidance that has been shared by the companies. Ashesha.
Well, yes, most large cap and several mid cap IT companies have now reported their numbers, and let's take a look at how they've performed versus each other. First up, let's talk about the constant currency revenue growth, where TCS reported a negative CC growth of 3.3%. We had all other companies also reporting, several other companies reported negative numbers. Remember, HCL Tech reported a positive CC growth of 0.8%, Tech Mahindra and Wipro at minus 1.4 and minus 2% respectively. Meanwhile, as far as EBIT margins are concerned, for TCS, they declined by about 30 basis points. For HCL Tech, we saw a decline of about 80 basis points. Meanwhile, Tech Mahindra reported a margin uptick of about 60 basis points. So that's the kind of move and constant currency growth and margin profile that we have seen for most of these IT companies. Now, shifting focus to some other parameters then, and deal win, that is also an important metric to watch out for. TCV growth for TCS came in at negative 23%. This was a major negative. HCL Tech reported a 40% drop in its TCV growth. We had Tech Mahindra and Wipro on the other side reporting positive TCV growth of about 1.3% and 26% respectively. As far as employee addition is concerned, HCL Tech and Tech Mahindra didn't report any employee addition. Nearly 5,000 employee addition is what we saw as far as TCS is concerned, although Wipro lost some of their employees in the quarter gone by. But what is crucial is the management commentary and the kind of guidance these managements have given. First up, Tech Mahindra, they said that they will exceed peer average in FY27. Some of positive commentary that came in from Tech Mahindra. HCL Tech, meanwhile, went ahead and cut their margin guidance. In fact, EBIT margin guidance has been cut to 17 to 18% for FY26. TCS said that FY26 is largely expected to be a better quarter for international markets. Meanwhile, Wipro, which reported its numbers yesterday, they said that the second half of this financial year is expected to be better than the first half, and they've given a constant currency revenue guidance of -1 to +1% on a sequential basis for the second quarter. So yes, it has largely been a mixed bag across companies in the IT sector, but commentary is something that will be keenly awaited.
Oh yes, that's that on IT. Pretty much most of the report card is out. But Dilip, not that the street was in any case going into IT earnings with high anticipation. Yes, there is a Wipro, which is a bit of a mixed bag. But I guess because of, the low expectations, Wipro managed to surprise on the upside. But do you think IT still remains an avoid?
Yes, certainly. I think in the absence of any great visibility over next couple of quarters, I think it's best to avoid IT for the time being. But not to forget, as I always mention, that most of these IT companies are very well managed companies, and EBITDA to free cash conversion is very strong. And I think though their ROEs have been coming down, overall, I think on a overall parameter basis, corporate governance, they have been pretty good. So I will not buy at these levels, but maybe if it comes down further by about 10% overall, that would be quite a bit expecting. But still, I think I would look to buy at lower levels. And just to give a defense to the portfolio, not to get anything great proactive returns on that, but that is how I would position and play IT.
Today coming in on IT, but yes, Mr. Bhatt, would like to thank you for taking the time out and speaking with us. Really appreciate that.
Always a pleasure. Thank you so much.
All right, moving on then, and let's have a quick look to some of the newsmakers and rather some of the buzzers in trade right now. Well, of course, post-market, we will have the earnings coming in from Reliance, JSW Steel, and coming tomorrow, HDFC Bank and ICICI Bank. These counters are going to be in focus. But Vinay, the other pack that is actually doing very well today is actually some of these oil and gas related companies, and I can see that throughout the day, it's ONGC which is now seen to be the top gainer in the Nifty 50. Anything on the charts? Because after a while, we are seeing select PSU counters trying to make a comeback. Anything that is looking good to you with respect to the PSU pack and ONGC in particular?
Yeah, so ONGC definitely has broken out from the short-term consolidation, and if I were to compare it with the Oil India also looks attractive because our fundamental team has already recommended long to our clients, and this is the company which we like as compared to the ONGC. And technical setup is also relatively supporting because Oil India has been holding above the 50 days and 200 days moving average, and there has been a golden ratio movement in the Oil India where 50 days EMA has surpassed the 200 days EMA. So on every parameter, the oil company like Oil India looks very strong on the charts, and fundamentally also we are bullish on it. So according to us, the support is around 430, 435 range. So that is a strong base for the stock like Oil India. The next resistance for the stock is around 475. So yes, from this particular space, we like Oil India, and support lies around 430, 435 range.